Varun and Charandeep Singh, they both join us. Now we interacted with them when the crisis was at its peak, and now a reasonable amount of confidence and some sanity and logic has really come back into financial markets, both globally and locally. So where do we go from here? We can argue that right now economy and markets are completely disconnected, and there is only one trick pony in the market, which is abundant liquidity by central banks. So if central banks are really driving the markets higher, then what could be the end game? Because liquidity and interest rates, liquidity is likely to remain high and interest rates are likely to remain low for a really long time. Varun, Charanjit, gentlemen, welcome back. Thank you for joining us. I'm going to start with you, Varun. The logic given by best of the global investors is that we don't understand this market. Economy is not headed anywhere. Companies are in a disarray. Managements are not in a position to give a guidance. The only reason why markets are going higher is because of liquidity. Is it as simple as a lot of experts are trying to make it sound?
See, my take here is, Nikunj, let me start by saying that markets are never obvious. They are always designed to fool most of the people and most of the time. So, things are obvious. If it was so easy to make money in the market, then everybody would be billionaires. So I would say that, bull markets are always born on pessimism. So I think this is a great, we are in a sweet spot where there is a overtone of extreme pessimism and markets are being extremely resilient. So I think that's a great situation to be in. And, when there's so much fear in the market, usually, what happens is there are two emotions. One is fear and the other is hope. But the problem is we hope when we should fear and we are fearful when we should hope. So I think right now I would rather be hopeful, because the way we are seeing in the market when we talk to businesses, I think there's a clear disconnect between businesses which are really badly impacted and there are businesses which are actually doing well. Of course, there is a short-term impact, but there is a lot of visibility in some of the businesses, some of the sectors. So I'm really hopeful that barring the liquidity aspect and that could come and go, I think fundamentals would prevail, and there will be a lot of leaders which will be emerging out of this new cycle, and it would not be the old ones. I think there would be new sectors, new companies, some unheard ones, and I think we could build on a new bull market from here.
Chanjit, while the optimist would insist that markets are a forward-looking mechanism and don't look at current year, next year may not be a great year, but if you have patience to look outside 18 months, even 24 months, this market is a great market. I buy that logic. But the challenge with that logic is that in last 4 or 5 years, every time people have argued that tomorrow will be better than today and day after will be better than tomorrow, that logic has got defeated, which is that hopes of an earnings recovery has not translated into reality, and markets time and again have got disappointed. So what is the guarantee that this time the optimism which is coming in on an earnings recovery and demand recovery 18 and 24 months from now will actually get challenged again?
Nikunj, firstly, good morning to you, all your viewers. Thank you for having us on the channel. We are glad to be back and to share our views with you. I think your question is quite loaded. I'll try to break it up, the answer. My sense, is yes, I think you are right. Over the last 5 years, your Nifty has maybe returned 2.5-3% per annum, if my numbers are not wrong. But, let me wind the clock back a little more. Let's go back to probably one of the most pessimistic times that we saw in Indian markets. That was the period from 2011 to 2014, right? Now, you had very similar kind of value available in the markets back then. And now I'm talking about broader markets, right? I'm not just talking about the top 50 companies in India, which are a very select elite group of companies, which also keep changing. If you look at that period and you built a portfolio at that time when the news was terrible, the headlines were terrible, there was so much pessimism, right? look, that pessimism slowly turned to optimism. And by 2017-18, you had virtually blowout optimism, So I think I do agree with what Varun said, that markets are made to climb a wall of worry. And look, bull markets are built on pessimism and they culminate on optimism. So I would encourage people to go out and build portfolios now. And don't just look at the headline index, because the headline index can be very misleading. It is presently loaded with probably 55% financials and consumer stocks, which is a very natural phenomenon since these stocks have done so well over the last decade and they tend to get crowded in the index, right? 2010, the index was crowded possibly with real estate and infrastructure names. Thus again, so the index had to consolidate, build a base, throw out some of the losers, add some of the new names. And HDFC Bank and a lever went from 50,000 to 1 lakh crore market cap to 6 times the size. So obviously their weight increased. To put this into perspective, not that I'm advocating you go out and buy telecom and pharma stocks, but these two sectors in the index combined will not be 10%, So I think it's all about perspective and it's all about navigating this. And it's not so straightforward as to say that the last 5 years have been 3% per annum returns. I think one has to dig a little deeper than that, which is my opinion.
Fair point. So let's look at the market into two parts, Charanjeet, then. You got good companies which are outperforming, where we know that the future will be better than the present, whether it is a company like Bharti or a insurance business like ICICI Lombard or HDFC Life, or maybe a stock like Reliance or Britannia. So my question is that where future looks bright, those stocks, aren't they priced to miss perfection on the upside? And where future looks dark, those stocks are languishing and are underperforming. The BHELs, the BELs of the world are the ones which currently are struggling, but that is where the value is. So how does one go about investing in this market? If you invest in the darlings of the market, is the margin of safety missing?
Fair point well taken. I think the way we like to answer this question is so I'll answer the value question first, right? So value can be very deceiving, right? One must be a value investor. I think that's an underline, right? One must buy value. But I will give you, again, anecdotal example, right? Let's go back to 2011. I love to go back to that part because that was the last cycle that I remember that was severe and sharp. Now, you had a Hindustan Lever probably trading at 35 times earnings. You had Bajaj Finance coming out of a 15-year cycle trading at, I don't know, it kept trading at 2, 3, 4, 5 times book. It was expensive at even 10,000 crore market cap. Hindustan Lever was expensive at 35 times earnings 8 years ago when it came out of this long period of consolidation and it made a new 52-week high. So yes, I do take that point. You have companies like BHEL which present enormous value. And possibly that value will get, the equity holder will probably gain some of that value. If the company gets bought or the government privatizes, we don't know. But it's very easy sometimes to write off big winners after they've doubled or after they are 50%. Saying, oh, बहुत high PE है, बहुत high PB है, मत लेना. But one has to really carefully evaluate the leadership and the growth. So really, is there growth over here that could be so humongous that people can't forecast? Secondly, are they leaders? Like, where is the competition? Do they have pricing power? Are they gaining subscriber traction or customer traction? Are the volumes growing? So I think one has to be extremely careful rather than paint everything with the same brush. Just because something's made a high or bottom, it's not to be ignored necessarily.
Varun, the fact that you'll continue to like Telecom, you own both Bharti and Reliance, is this a pure bet on data binge and consumption? Because for those who are buying Bharti, the spanner in the wheel or the cog in the wheel really could be the AGR issue, which still has not been sorted.
Right. So, for us here, we really like the tailwind in the industry. Also, on the face of it, of course, they've run up in the short run. So it looks that they are expensive. But one has to understand the amount of investment and the consolidation that has happened in the industry. from being about 15 to 20 players, now there are only 3 players, and 2 of them are very, very strong. So I think more than, the AGR dues is a very, very, I believe it's a very small piece in the entire opportunity, because I feel that there is a very vast opportunity and a huge tail, and you could have a profit pool which could be in lakhs of crore. So I think if one goes ahead, probably 5 to 10 years ahead, you can easily make a case that the ARPUs are going up. You can easily make a case that the data usage is going to go up, and there is going to be not that much competition because there are pretty much 2-3 players. So I think it's a combination of all 3, and the investment, a large part of investment is already done. So every additional subscriber, every additional price increase, a large part of it goes to bottom line. So I think one can put that into paper, but when it really happens and when the numbers truly come, I think that's when the stocks appreciate and react, and then you will see weightages in the index increase, and you will see a lot of things happen. But see, it is not a straight line. You could see times of consolidation. You could see bad news come. The stocks might react. But I think the long-term story remains intact for us. And that's why we like it.
Sanjit, again, the way I look at your declared portfolio, whatever is there with us, some of your stocks are part of your presentation, ICICI Lombard, Bharti, Reliance, DMart. We've argued in the past that you like some of the best franchises in the world. But my follow-up question again is that in this kind of an environment, when markets are simply voting for safety and for survival, don't you think some of these companies are priced to perfection? I want to go back to that pricing point once again, because when Devant went public, everyone came on my channel and said, "Arey, mehenga stock hai. You will not make too much of money. You will not make great returns if you buy stocks at P multiples of 40, 50, even 50 times." Guess what? All the naysayers have been proven wrong, and DMart has gone from 500 listing price to about 2,500. Abbott was at 2,000 couple of years ago. Now it is at 10,000. How do you defend these arguments? Because I'm sure your clients must be asking you the same questions.
I think a very fair question, and I'll answer this question as a portfolio manager should. You see, we build portfolios. We have 20 to 25 companies in our multi-cap portfolio. What tends to happen is we tend to overweight and underweight certain stocks over time. So we have held DMart since the IPO. Now, obviously, had we continued to hold our original position, it would have been very large. So we have been taking profits along the way. So we do go out and reweight and rebalance our exposures over time, if they become too large or if we feel a lot is priced in. We have methods to do that. We're very systematic like that. So we would, assuming something becomes too large and we think too much is priced in, we tend to reduce the size of that position. You mentioned DMart in particular, which is why I used that example. That's really how it works for us. And I think your other point about being priced to perfection, I will again, come back to that point about leadership and growth. I think it's very important not to take one's eye off the quality of the leadership and the size of the growth opportunity that lies ahead of any company that one wants to own. Once it is established that the company is a true leader, it is extremely important that it is growing. So yes, I could be willing to pay a 50p for a company today, but who's to say? What if the earnings double in the next 3 years? But then it's not 50p. So the idea and the art here really is to look forward and to be able to make a case that you are truly in a leader and that is truly growing, because markets do tend to reward growth. Again, what you saw between 2010 and 2020, the entire consumer and financial bull market, growth kept getting rewarded. Consumer kept looking expensive. Financials kept looking expensive, but the growth kept coming and the P's kept expanding. But hey, look, when the growth stops, this is what happens. It's right in front of you, the correction in the financial space, and even select consumer pockets, which have become so expensive. So it's very important to be able to understand leadership and growth. I think without that, becomes an exercise in isolation.
Is it a conscious strategy that you want to avoid companies which are heavily leveraged? I'm keeping Bharti and Reliance aside. Those are debt. They have debt on their balance sheets, but that's not a problem for them to serve. But in general, the assortment of your companies or where you've taken large bets are almost zero debt companies.
Learned, and sometimes the very hard way, since we started Girik, is that great companies don't leverage themselves. There are very few like Reliance that can get away with it. Leverage kills. It's not easy to manage leverage. You have to have leverage of the right proportion, the right cost, and the right structuring. We find that Indian companies in general have not been successful employing more leverage than they should. Very, very few have. So in general, yes, I would say it is virtually a conscious strategy to avoid leverage companies in India. And I found that the greatest companies, of course, other than the financials, have not needed to leverage themselves to succeed. They have very high ROEs and very high return ratios, superb margins, great working capital cycles, and the leverage requirement is absolutely de minimis.
I want to go back to financials and something which we discussed last time, and I think the trend what you discussed, Varun, is getting more and more prominent, which is that large players are getting bigger and the small players are getting very marginalized. But within the banking space now, Varun, you got two extreme ends. You got an Kotak Mahindra bank, which is able to raise capital on will and on demand. And you got a bank like RBL and AU Financials, which is clearly struggling. Now, they both are good franchises, both in terms of understanding risk and also in terms of insolvency risk. But markets are pricing the banking space rather differentiatedly. 3-4 months ago, AU was trading at a premium to Kotak, and IndusInd was commanding P price to book, which was at par with Axis Bank. But now the Sheikhost has really created a big valuation gap there. So what are your thoughts in the big gap which is now there within the private banking space?
Yeah, great question, Nikunj. We truly believe that, this relative valuation could be a very big trap. So, when I remember when DMart was trading extremely expensive, people went and bought cheaper stocks or cheaper retail franchise like Future Retail or any other. And we completely saw that people eroded a lot of value in buying the second best or the third best or the fifth best. So we are truly believer in buying the best franchise, and the valuation gap will always remain, and the leaders will always reward. So if we are not extremely bullish on financials, but if one has to look at financials, I would say just stick to the leaders, stick to the private guys, the large ones, and very important, the ones which can raise money, because I think that is the raw material for the banks. And if you cannot, then the growth stops. And when the growth stops, we saw it with the PSU banks. When the growth stopped, all the problems started coming, the NPA started coming. So I would really say that I think catching a falling dagger is not a good strategy. I would rather recommend to stick to leaders like HDFC, Kotak, maybe ICICI, but I think going beyond that in a sector which is seeing a lot of headwind, I think it's a big mistake if you do that.
Sanjit, do you think consumer staples, the Britannias, the HULs, the Nestles of the world, now will struggle to give double-digit returns on a CAGR basis for next 5 years? Is that a fair possibility?
It's a possibility. I think, again, a lot of this depends on the earnings growth. Look, companies like Nestle, Lever, some of these very, very large entrenched franchises like Britannia, they have become so large and such amazing market leaders. And, I think for them to squeeze out double-digit growth isn't that hard, right? These guys are so well organized. They sit right on top of the food chain. So earnings for these guys could keep growing. For the entire consumer bank, I don't know. What tends to happen is when, the leaders in a particular sector do well, the entire sector does well, everybody, raises capital and the party continues. And it happened in the last decade. But I think leaders will always differentiate themselves. I would be a fool to tell you that and bet against guys like Lever, Nestle, Britannia, because these are truly amazing companies. Who am I to say they won't deliver double-digit returns? It's extremely possible that this may not happen over a 3-year period, but over a 5 to 7 year period, it may easily happen.
So what is that level at which you would say, look, we are living in a world where P multiples will expand because the underlying cost of holding the asset is very low. So we will have to live in a world of high P multiple for great companies. But here's the turning point for me, Charanjit, in my portfolio, where I will not get carried away because of the strength of the franchise or because of global liquidity. I will decide to log out because I cannot justify that. So what would be that point somewhere in next 1 or 2 years where you would say, look, I'm happy to take my chips off the table irrespective of what central bankers are doing?
So, I'll tell you firstly, Nikunj, I'll be very honest with you. We at Girik, we have and will continue to, we have over the last decade paid very little attention to headlines, what central bankers are doing, because we respect what these guys do. But it is absolutely not within our skill base or our skill set to actually evaluate how much liquidity there is in the system, how much of it is going to come into Indian markets, how much is going to get allocated to high yield bonds. These are very difficult things to track. I think what we will do and what we continue to do, and we think we do a reasonable job of, is to actually understand the businesses we are in, identify their leadership and get the growth right. It's extremely important. You gave that Lever example. Look, we may not want to own some of these large consumer franchises. I'm just using this as an example because we don't think the growth is sufficient to justify the multiples. They're great leaders. They can be in a portfolio for 20 years. Sure, you may get to double-digit return. We want to ideally make much more money than that. We're going to go out and keep looking for new winners. T-Mart was an example at an IPO. People at that time, it was 50 PE. Now, when you look back and look at the earnings expansion, it probably traded at 15 or 12 PE. You look back 3 years. So everybody got the earnings wrong, because people didn't spend time to understand the leadership of this business. So the idea is you're not going to get everything right in a portfolio. Out of your 10 or 15 companies, if you're able to even get 4 or 5 of these right, and the earnings growth is outsized, you will get rewarded like you did in the financials in the last decade, like you did in the Titans and the Whirlpools and the great consumer franchises of the last decade, where a massive re-rating continued because the earnings growth just surprised the entire sell side. And it kept surprising most fund managers. That's when the chase begins, so to speak. And ideally, that's when you do get an exit. So I think to answer your question, which is a very good question, it's a very challenging question, because these are things we think about every day. The idea is to keep identifying new winners, keep understanding where the leadership is and where the growth is. And there are enough sectors out there today which are showing characteristics. There are companies out there which are showing growth. There are several companies, I'll tell you, which earnings have exploded in the last 2-3 years. The stocks are up 5 or 10 times. The idea is to essentially understand those and own those.
Well, gentlemen, really appreciate your time and appreciate that you've been so frank and vocal about your thoughts and how you're following a different strategy. We interact with money managers and rest of the money managers on a daily basis, but I've always admired this about you, that you were able to think differently, act differently, and take risk. I wouldn't say risk, but make assumptions which are based on logic, not on crowd and ownership and liquidity. So appreciate your time, stay safe, and thank you for joining us.